It's one of the most robust ways of investing. In this video, I'm talking about investing using a core satellite approach. Now, this is an updated version to one of my previous videos where I've spoken about the same topic, but I want to elaborate just a little bit more. Now, first of all, everything's covered under general advice and factual information. Using a core satellite approach, you can get the benefits of tracking the market at the lowest possible cost using something as simple as an ETF or a managed fund, and then with a portion of your portfolio, you can put it to work in strategies that you think are going to give you either some form of outperformance or an area of the market that you may have a personal interest in. The approach can be used for anyone who's looking to build long-term wealth and they want to have an active interest in their investments. Now, one of the key benefits of this is that you're going to minimize risk and you're going to gain more market awareness, and you're going to do that right throughout your investing journey. Now, one of the reasons why I think this is beneficial is that you take small amounts of risks early whilst you're still learning it. And as you become more skilled and you learn more about the market, and once you understand more about investments, then you can still change your portfolio to take advantage of opportunities that you see and that you think may work out well in the future. What is a core satellite approach? Well, like the name implies, it has two components. The core is where you allocate the majority of your capital to, and that generates the bulk of your returns. Now, the general idea is that you want to put that into a low-cost investment solution that tracks the market. The second part is the satellites. Now, this is where you get the opportunity to tilt your portfolio to specific segments of the market. Now, some people might tilt their portfolios towards either yield, value, or they might use active or passive products in order to get the exposure they want. Some people might use listed investment companies or property trusts. It really comes down to your personal preferences. With that said, some people might like to trade a portion of their portfolio or use complex strategies like options and different derivatives in order to hedge their portfolios. How much money should you be allocating towards the core and the satellite in the portfolio? And the way I like to approach it comes back towards preferences and experience. So somebody who's just starting out, if I was just starting out, I'd like to invest between 80 and 90% within a market tracking ETF and get the market return at the lowest possible price point. The second part of this with the satellite is I'd allocate whatever's left over, and then over time, I'd then grow the satellite portion of the portfolio. So to use big round figures, if I was putting $100,000 to work, I'd put $80,000 in an ETF, and I'm talking about VAS or STW or the, I think it's called the A200 from Beta Shares. It really makes very little difference to me in that kind of situation because they're all very, very similar products. I've got an old interview with one of the VPs from iShares, and I also own the product. So I think that's a pretty fair disclosure on the background there. I'll link the video to this one as well. Now, what I'd do in the future if I've put $80,000 of a hypothetical $100,000 to work is that I'd put $20,000 in something that I'm finding engaging. And this is going to give me the market awareness, and it's going to help me develop my investment understanding over time. After I've allocated the initial capital of $80,000 towards the core and then $20,000 towards the satellites, once again, it might be a listed investment company that I think is cheap. It might be an active trading strategy that might be based on value or growth or income. The next part of this is, what am I going to do in the future? And the answer is, I'm going to do two things. The first one is I'm going to look to add to my portfolio over time. And then the second thing is that I'm going to reweight my portfolio on at least an annual basis. Here's a slide from my previous videos, and I think it's really important to just explain that this is an example using an 80-20 split on the Australian equity market, and a handful of products which I think represent the asset class or the product or the strategy as a whole. If you like this video, you can always watch more of my content by clicking on these videos here and here.